People believe banks are simple institutions, a place where money is stored, a place where savings are protected, a place where one person's money is safely kept and then lent to another. That's the story we've all been told. You deposit your money, the bank keeps it, and then carefully, it lends that money to someone else. This story feels logical. It feels safe. It feels familiar. But it is completely wrong. Because banks do not lend money that already exists. They create money. And once you understand this single fact, everything you know about the financial system changes. Let's slow down. Think about your bank account. You believe the number you see on your screen represents real money. Money that exists somewhere. Money the bank is merely protecting for you. But that number is not money. It is a promise, a digital entry, an obligation. When you deposit money into a bank, the bank does not place it into a vault with your name on it. The moment you deposit your money, it no longer truly belongs to you. Legally, it becomes the bank's asset, and what you have instead is a claim, a promise that the bank will give it back when you ask. This detail alone already changes everything. Now here's the part people rarely question. If banks only lent out deposited money, how could they possibly make enormous profits? How could the entire economy continuously grow? How could debt expand faster than income? The math wouldn't work. And that's because the system doesn't work the way we were taught. Banks are not intermediaries. They are creators. They create money the moment you go into debt. Not years later, not gradually, instantly, and entirely. But before we explain how that works, we must first dismantle the biggest financial myth in modern society, the belief that banks lend existing money. Imagine you walk into a bank. You apply for a loan, let's say $100,000. You believe the bank checks its reserves, checks how much money it holds, and then gives you part of someone else's savings. That never happens. The bank does not look for money. The bank creates it. When your loan is approved, no physical money moves anywhere. No other account is reduced. No depositor loses funds. Instead, something far stranger happens. The bank simply types numbers into a computer, and with a few keystrokes, $100,000 suddenly exists. At that exact moment, two things are created simultaneously: an asset and a liability. The loan is the bank's asset, your debt. Your account balance is the bank's liability, your newly created money. Both are born from nothing. No gold, no cash, no prior savings required, just accounting. This is known as bank credit money, and it makes up the vast majority of money in circulation today. Not cash, not coins, debt. Here's what makes this system so powerful and so dangerous. The principal of the loan is created, but the interest is not. If you borrow $100,000, you are required to repay more than $100,000. But that extra money is never created at the same time, which means the system requires continuous borrowing just to pay old debts. Debt must expand, or the system collapses. This is not a flaw. This is the design. Now you might ask, if banks can create money endlessly, why don't they just create infinite wealth? Because creation comes with control. Banks create money selectively. They decide who receives credit, where money flows, which industries grow, and who is left behind. Money is not neutral, and it never was. Most people think money represents value. In reality, it represents power. The power to decide who gets access to the future and who must struggle to survive within it. And once money is created primarily through debt, control becomes embedded into everyday life. Mortgages, student loans, business credit, national debt, all born the same way, from nothing. And this brings us to the most important realization. Banks do not create money to serve the economy. The economy exists to serve the system. Because if money enters the world through debt, then debt becomes unavoidable. And if debt becomes unavoidable, then control becomes permanent. If this system feels unfair, if it feels imbalanced, if it feels fragile, that's because it is. Yet, despite knowing this, despite countless financial crises, despite market collapses and recessions, the system never truly changes. And the reason is simple: because the system cannot change. Modern economies are not built on money. They are built on debt. Governments do not print money to run society. They borrow it. Corporations do not grow with savings. They grow with credit. Even survival for millions of people depends on access to debt. When an entire system is fueled by borrowing, removing debt would be like removing oxygen. Every major institution relies on this mechanism. Banks rely on loan creation. Governments rely on bond issuance. Markets rely on cheap credit. So when crises happen, the solution is never to create less debt. The solution is always more. More lending, more stimulus, more liquidity, more money created from nothing. This is why financial crises do not reset the system. They reinforce it. Each collapse pushes society further into dependency on the very mechanism that caused the collapse. And each rescue strengthens the institutions that control the flow of money. You might wonder, why do governments allow this? Because governments are not outside the system, they are inside it. Governments borrow from the same mechanism. Governments owe interest on money they did not create. And that interest can only be paid through taxes or through more borrowing. The loop is complete. Once a system reaches this stage, there is no incentive to simplify it. Complexity becomes power. Financial language becomes impenetrable. Balance sheets become abstract. And responsibility becomes invisible. The system no longer needs to be understood by the people living inside it. It only needs to function. And when people feel pressure, they are told they need better budgeting, better discipline, better habits. But the pressure is not personal. It is structural, designed into the system itself. So where does that leave you? Not desperate, not powerless, but aware. Because awareness changes the relationship. Money is not evil. Banks are not villains. They are mechanisms, designed with specific incentives, operating exactly as intended. The danger is not the system itself. The danger is living inside it without understanding it. When you realize money is created through debt, you stop blaming yourself for running in place. When you understand how credit shapes opportunity, you start seeing patterns instead of failures. Awareness doesn't break the system, but it breaks illusions. This knowledge won't make you rich, but it will make you conscious. And consciousness is the first step to freedom. Not escape, but navigation. Every financial decision becomes clearer. You begin asking different questions. Am I buying access or comfort? Am I borrowing growth or postponing pressure? Am I using the system or is it using me? These are the questions that matter. The financial system does not collapse because people learn the truth. It evolves slowly, through understanding, through education, through awareness. This channel exists for one reason, not to scare you, not to sell you shortcuts, but to decode the systems that shape your life. In the next episode, we answer the question that naturally follows this one. What happens when money is created endlessly? And why, despite working harder than ever, people feel poorer every year? Because the answer is inflation.